Hi, this is Randy Woodruff with Suncoast CPA Group, and I got in the studio today my business partner, Eric Arnett. Eric and I own Take Point Wealth Management together. Eric, good to have you here today.
It's great to be here, Randy. Thanks for having me.
Yeah, absolutely. Well, as I mentioned, Eric and I are partners in Take Point Wealth Management. Eric and I have known each other for probably at least 20 years. Eric's been in the community for probably 22 years.
I think it's about 22 years.
22 years, yeah.
2001. So
2001, yeah, close up to 22 years. And Eric and I have been together in Take Point now about 3 or 4 years and working together with our clients. And I wanted to have him come in today to talk about some of the things we're doing over there. And thought we'd start off with kind of a market update. You know, this year has been anything but normal, and seems like every other week, every other day, the market's going in some kind of topsy-turvy direction. So why don't you kind of give us just a current market update where things are, kind of maybe some information why things are so volatile, and then we'll get into some other topics.
Yeah, sure. So, I mean, obviously, if our listeners have looked at their 401ks or their IRAs lately, they've probably seen somewhat of a decline. The stock market itself, the S&P 500 is down close to 20%. The NASDAQ, which is more your growthy stocks, your technology stocks, higher growth, aggressive stocks, pushing close to the negative 30%.
Are they really down that much this year?
Yeah, so
wow.
We had a nice little rebound in the summertime for a little bit after the big sell-off, which kind of stopped in June, and now we're giving that all back again here recently. So it's been record volatility. If we go back in history and we look at the measure of volatility, 2022 has set several records. One is volatility. We've actually had, interesting enough, we've had 33 days where the market has moved a negative 2%. Likewise, we've had a matching 33 days where the market has gone up 2%. So that is anytime you measure negative 2% days and you have that many positive 2% days of that magnitude, that's volatility. In fact, yesterday, for instance, the market opened up down 2%, then it swung, it was up 2%, so it was a 4% swing right there, and then the market closed down 2%. So we had like 6% swings on an intraday level.
In one day?
In one day, yeah.
Wow.
So record amount of volatility. We've had, the markets are down. The other the big story really is it's not so much the stock market, but it's the fixed income market, bonds. We say fixed income, we basically mean bonds, and so a lot of you folks out there probably have bond mutual funds inside your portfolio, and you're like, hey, this was the portfolio that my advisor told me was supposed to be the conservative one and not lose money, yet the aggregate bond market this year is down 13%. That's also a record since in our nation's history. So a lot of records being set this year. So
good and bad.
Good and bad. And so basically, nothing earth-shattering here. Most people know that the reason that the markets, when I say the markets, I mean the bond and stock market, have really been topping here and kind of in somewhat of a volatility free fall, is that the Federal Reserve came out and said, last year, we started getting hints prior to 2022 that the Federal Reserve was going to start to raise interest rates. And so when you've been at basically a 0% interest rate for such a long period of time, and the Fed starts to raise rates, obviously it's going to cause a shock to the market. All of the markets, everything that we do are tied to interest rates. So when we're at 0 and all of a sudden now we're moving up to 3-4% on the federal funds borrowing rate, which is basically the interest rate that kind of everything's tied to, and we move up that rapidly, the Fed basically came out and said, hey, we're going to probably aggressively raise rates this year. So that's basically put a brake on things. And so really what the Fed's doing right now is they're trying to pump the brakes and figure out how much we have to stop things here to stop inflation. So the reason, why is the Fed raising interest rates? Well, it's because of inflation, right? We have another record this year of historical inflation that we haven't seen. We've only seen inflation like this one time, and it was back in like the 30s. Don't quote me on that, but this is the second largest rate of inflation in a one-year time period on record. So when we have massive amount of inflation, the Fed has to do something to kind of slow that growth down, try to tame inflation. So how do they do it? They raise rates. And so we think that the Fed is going to continue to raise rates here going into the end of the year, into the fourth quarter, probably raise another whole point. Some of the forecasts and things that we're looking at and what's kind of baked into the market is like we think that the Fed will hopefully stop around 4.25. It's at 3.25 now with the recent rate that we had yesterday. So we think a whole nother percentage point probably coming here. And then we hope, we really hope at that point that the Fed kind of eases off and kind of takes a look at things and sees what's going on, because with the Fed already raising rates and with the high inflation, we've already seen demand. We've seen some of the numbers starting to come down. So the economy is starting to cool. We're nowhere near a recession yet, but the economy is contracting. It is cooling off. So a lot of numbers that we look at. So the economy is already slowing down. So the real question is, and why the market's so berserk and why the market's just freaking out on a day-to-day basis and quite frankly kind of selling off to the downside, is because the market has no real clear indicator as to how far the Fed's going to go. And also we don't really know if there is a recession, which some of your experts, I think 50% of the economists that are polled right now are, it's given it a 50-50 chance that we go into recession into 2023 or late 2023. And so with that being said, we don't know if there is a recession. Is it going to be a deep recession? Is it going to be a mild recession? And so that's why the market's trying to price all that in. And believe it or not, the stock market itself, if we just want to talk about the stock market, is fairly valued right now when we look at historical, PE ratios, price to earnings ratios. However, we have seen in periods of time where the stock market can go much lower than what the fair value is. So, still a lot of uncertainty there. I think that there are some good things out there. The jobs are still strong. The job market's very strong. There's a ton of cash, historical levels of cash out there on the sidelines, still fluid. So at some point that's got to come back into the markets. So the minute that the Fed says, hey, we might slow down, or we might maybe pivot and think about staying neutral or even lowering rates, until we see that, the market's probably going to continue to kind of trade in this very choppy, volatile time. So a little bit more of a market update than maybe you're looking for.
No, that's perfect. Very informative.
There's all kinds of stuff we can talk about. But the big challenge for folks is, if you're out there and you're close to retirement, in retirement, maybe you're in your 50s, late 40s, the big challenge is that conventional portfolio where people were hedging against the stock market with bonds, because typically we were always told that bonds are not correlated to stocks, right? Well, that isn't the case anymore. And we don't think that the picture for fixed income or bonds is going to get any better anytime soon. Even if let's say the bond market does level off next year, you're still only looking at a 3%, 3.5% 10-year return on a bond, right? And when we factor in inflation as high as 8%, you've got a big gap there that you got to make up, or your purchasing power is just withering away, and you're basically losing money every day. So we still think that stocks are going to be, where you can beat inflation long term, and perhaps this is a buying opportunity for stock investors. So you don't want to be buying stocks when they're at their highest, no. Right? You want to buy stocks when things are their darkest and things look horrible. That's when you want to be adding stocks to your portfolio. And you're never going to time it perfectly, but I tell people, like, hey, if you buy a stock today, are you willing to lose 10% on paper for potentially making 30, 40, 50% on your money a year or two from now? And typically that's what we see is, even when we're in a recession or going into a recession, we'll see negative returns on the market. But once we're in the actual midst of the recession, we start to see the markets recover. 1 year after a recession, high double-digit returns. 2 and 3 years after recession, really high double-digit returns, like 40, 50, 60 percentiles. So, you just got to kind of, I know that there's a lot of emotions around money and people are scared and concerned, but you just got to kind of hang in there. And, there might be some changes you can make, some tweaks we can make, and we can talk about, all those different strategies. But in general, that's kind of what's going on in the markets right now.
You touched on a couple of things I was going to ask you about interest rates and how those rising interest rates are impacting bond values. And so if you bought some bonds over the last year or two with rates being so low, rates are going up. You can buy new bonds, if you will, at much higher rates. And so nobody's going to want to buy those bonds that had real low rates. So right. That makes sense that bond portfolios are down 13% year to date. So and we're talking about...
And I might say, just, and not to toot our own horn, but you and I do a radio show, Take Point on Retirement. It's on 99.9 here local. We also have a podcast, Take Point on Retirement. You can get our podcast on any podcast app. Mm-hmm. But you and I, and I'll hold people to this. You can go back and look 2-3 years on our radio shows and podcasts. We were telling people 2 and 3 years ago that you needed to get out of bonds. Mm-hmm. And so, and that's been a strategy here at Take Point for our clients for quite a while. We've been utilizing bond alternative strategies for quite a while. So it's not too late, because I think that's just still going to be dead money for you if you have money in bonds. And by the way, you're probably paying a fee on those bonds as well.
To manage them.
Yeah.
Paying a fee to what you lose money. So
right.
Yeah, you're right. We have been talking on a radio show for a couple of years now, at least, about looking at annuities as a bond replacement strategy, and for our clients that have done that, have done very well. Just talk a little bit about annuities. Before we go into that, you also touched on inflation. That's having a big impact on the economy. And what's your thoughts on, so far this year, the consumer has been very strong, and I think the consumers, I think some of this, people were, inflation just really starting to raise its ugly head this year. Gas prices really came on strong. Interest rates have shot up. I think the consumer stayed relatively strong. I think part of that had to do with, people already planned to take summer vacations. They've been in COVID lockdown for so long. They were going to get out of the house this summer and spend some money, get past back to school. What are you hearing in terms of what do you think guidance is going to look like? Because we got third quarter earnings coming up in about 2.5 weeks. What do you think the guidance is going to look like coming out of these companies in third quarter? Guidance for, where, back up. How well do you think these companies are going to make their earnings, and what do you think the guidance is going to be going forward, as we talk about more and more recession worries? Think we're going to have some downward guidance going forward? Holiday sales, what are your thoughts on all those items?
Yeah, so great question. We've seen big companies like FedEx, for instance, has recently just came out and basically guided down and saying that they're seeing a global recession and a global change in the amount of packages that they're shipping. And so that right there is kind of an indicator, right? And so, unfortunately, when you're trying to read an economy, most everything's lagging indicators. No one has crystal balls. But when FedEx comes out and says, hey, package shipments are dropping off, rapidly, we're going to start laying off people, we're going to have to cut back, all these kind of things, preparing for a global recession. It's pretty telling. And so people tend to forget, too, is it's not just the USA anymore. We are a global economy. We're all tied together. 60% of the S&P 500 earnings come from other countries. And so it's not like it used to be where you just had to worry about what was going on in the U.S. And unfortunately, we're seeing a global slowdown. Potentially China is coming back on board here as they open up more and more out of COVID. So things may pick up a little bit there, but
to your point real quick about us being a global economy, I think we saw that during the pandemic with the supply chain issues and how much we really are all tied together, and the lack of just all this, all the shipping back and forth across the Pacific, all the ships sitting there off the coast of California couldn't get in, So to your point, and it's real, we can look back at that and really, we really are all tied together. More than we really know.
Yeah, I think the consumer is definitely tightening the belt. I think we're going to see. I think the markets are going to calm down here in the fourth quarter. I think a lot of the bad news is kind of already baked in. However, we're going to see continued guidance downward with corporate earnings, and that doesn't bode well for stocks. And so you've got to look at different strategies, different alternative strategies where we can add total return and yield to portfolios. And so there's a lot of different things out there we can do than just stocks and bonds. And so if you're just in that conventional kind of portfolio or that kind of conventional relationship with a broker or an advisor, I urge you to get a hold of Randy and lean on him for some resources and try to get in touch with us so we can look at what you're doing and potentially offer you some alternative strategies, because this is going to be kind of a tough period for a while here.
I agree. We were talking about bond replacements. Before we go to that, rising interest rates. It's great if you have your money in the bank and you're looking for CD rates and maybe some bond rates, but when rates go up, our federal government also has a lot of debt, $31 trillion now worth of debt.
Right.
And so, just want to make sure everybody's aware of that. As rates go up, it is going to have an impact on it's going to cost us more as a country to borrow money, which we're still borrowing. We got a huge debt now, and eventually taxes are going to have to go up. We talked about that on the show, for many reasons. And so people have asked me, well, how high do you think rates are going to go? And to your point, I don't have a crystal ball, and nobody does, but I look at, $31 trillion of debt nationally and rising every year. I don't think rates can go up that much further until it's really going to start squeezing our ability to borrow, and it's going to raise our borrowing cost. So question I've had floating around the back of my mind is, how much is the Fed really going to be able to raise interest rates, and how much can they really control inflation? Because they have this, they want to control inflation by raising rates, but they can't go too high because we have all this debt. So, it's we're kind of in unprecedented times. These are all unanswered questions, and we're not trying to answer them here today. But we remind all of our listeners, and we've said this on our radio show as well at Take Point, that you need to stay nimble. You need to be thinking about making sure that you don't lock yourself into some long-term decisions that you can't get out of in case you need to pivot quickly. So that's one of the things that's been heavy on my mind as rates have gone up, is what's this going to do to our our ability as a country to continue to pay this debt, and we're going to be borrowing money to pay the interest, which is just it makes no sense. If you're a consumer and you're having to borrow money to make your interest payments on your debt, that doesn't make sense to us as consumers. It doesn't make sense at the government level either. So, we're going to have to make some significant changes, in my opinion, in a short-term, definitely on a long-term basis, to our whole country's finances. So, to your point, definitely need to look at your portfolio. Be thinking about all these things and make sure you got a well-balanced portfolio. And talking about a well-balanced portfolio, we've been recommending a bond replacement strategy for years. Talking about annuities. And we've all, some of my clients have bought some annuities back in the 80s and 90s, and I think there was kind of the wild west here in Florida back in those days. So there was some negative thoughts or stigmas tied to annuities, but I think there's been a lot of extra regulation. Florida and other regulatory agencies have put on annuities and annuity advisors that are getting compensated. So if you just want to talk briefly about annuities, that we recommend a couple of different ones for clients, and how fixed index annuity can be a great bond replacement strategy.
Yeah, so I mean, annuities aren't for everybody, and they are for some people, right? And so every time someone sits down with us, we're going to go through and build them a customized plan. One thing that we don't do here at Take Point is just, broadly apply one strategy to everybody that comes in the door. So every family, every person, every business that comes in the door is going to have a customized strategy for whatever their goals are, their needs are, risk tolerance, so what age category they're in. And so, really it gets down to, what is the client trying to accomplish? So repeat your question, because I forgot what you even asked.
Cut? No, great.
Cut?
No, yeah. No, so we were talking about using annuities as a bond replacement strategy.
Yes, back to annuities. So, Yeah, so we have, annuities aren't for everybody, and we do have other bond replacement strategies like structured notes, buffered ETFs. However, there's a lot of annuities out there, and like you said earlier, some have gotten a bad rap. We like and feel strongly about indexed annuities, fixed indexed annuities. We're not a big fan of variable annuities or immediate annuities, and those are the ones that kind of got the bad rap. Mm-hmm. A variable annuity is still invested in the market, and they have extremely high fees. And so, and they used to tease people with this income rider and say, well, you're going to get a guaranteed 6% roll up on your money. Well, people thought that was their actual cash value was going to grow 6% guaranteed every year. No, it's just a fictitious calculation on a potential income payout in the future. And so, it was kind of deceptive. We went through the lost decade in the 2000s, and people all of a sudden got their variable annuity statements, and they were way underwater, but they had a high income rider benefit, so they were kind of locked and stuck into it. Well, I lost all this money, so I might as well just turn on the income rider, and now they're stuck with that company for 20, 30 years. And so, unfortunately, a lot of guys out there, insurance agents and whatnot, just blindly applying those across the board. And then we had the immediate annuity, which was the devil, out there. You had insurance agents knocking on little old ladies' doors saying, hey, give me all your money. I'm going to give you this nice guaranteed payout. Well, the problem with that is once it goes into an immediate annuity and they start the payout, now your principal is basically gone. It belongs to the insurance company, and they're going to pay you a nice income stream for the rest of your life. However, you have no access to that lump sum cash in emergencies or if you need to get a hold of some cash. And so, and they had 15-year terms on them and stuff like that, and put 90-year-old women in it. That doesn't happen anymore. That was way back when, the Wild Wild West. In Florida, particularly to protect seniors, there's been a ton of compliance. We have a 10-10-10 rule. You can't get more than a 10% bonus to tease somebody. You can't be in an annuity more than 10 years, and you can't have the annuity can only have a 10% surrender value. So there's a lot of things in place, but we love index annuities because, quite simply, you still get stock market and bond market like participation, but your principal is 100% protected. Mm-hmm. And we try, and most of the time we find index annuities, believe it or not, there's a lot of them out there that have no fees. So you're looking on getting the potential growth on your portfolio with no fees, and then you're taking out all the risk that is in the bond market, like interest rate risk and reinvestment risk and all that kind of stuff. So we like index annuities. They're not for everybody. We actually have a book called Annuity 360.
Great book.
So I encourage people to reach out to you, and however they're going to get a hold of you, through your email or call you or whatever, or you can go to Take Point and click on Take Point's website. In the upper right-hand corner, you can request a copy. We'll mail out a copy of Annuity 360. This is a great book that you can just take and read and study for yourself. I tell people, don't take my word for it. Don't take other advisors or brokers' word for it. It's your money. Be responsible, be in charge, educate yourself on your own money, and read this book. Read Annuity 360, highlight it, tear it apart. We actually had a guy read it 8 times one time, and this gentleman was anti-annuity because he heard from his neighbors or auto mechanic next door that doesn't know anything about the markets, like, hey, don't buy annuities. Well, so he was all fearful of annuities. He read this book 8 times, and then we had over 4 or 5 meetings with him, and he finally invested quite a bit of money in index annuities and built a nice comfort level with them. And he thought to himself, why didn't I do this earlier before, and why doesn't everybody do this? And quite frankly, it's just because the public isn't educated enough on all the different types of annuities that are out there, and in certain cases when they should be used and not used. But I think Annuity 360 is a great way to start.
It is, yeah. I read the book myself, and it's a super easy read, and it definitely does get rid of a lot of the misinformation or myths that are out there about annuities because of all the, I'll say, bad actors in the industry from 20 years ago or so. Let's talk a little bit about, and we talked about this on our Take Point radio show, but Roth Conversions. This has been a man, I want to do with the market down, may or may not, but your Roth conversion is where you can take your current IRA and you can roll a portion of it into a Roth IRA. You have to pay tax on the amount that you roll over, and we can help you out with those tax calculations. We have clients that we do every year. We meet with them towards the end of the year. We say, okay, where are you at with your taxes on all your other income for the year? Plug that information in, then we just start playing with the numbers and say, okay, if I put $50,000 into a Roth, $75,000, $100,000 into a Roth IRA, what's that going to do to my taxes? And so we're seeing a lot of people start to take advantage of that. It's nice to have. For Eric and I as advisors, it's nice to have, I'll say, different buckets of income to pull from as your retirement. As we're trying to strategize if we've got some income that's taxable, some income that's non-taxable, other assets, maybe you got some rental property that you're renting out, just different. The more income streams you have, different tax structures that you're involved in, the easier it is for us to do our job and to plan effectively for you. So I know I kind of talked about Roth IRAs. Anything you want to add to that?
No, I'm glad you brought them up because I think they're an amazing tool. Unfortunately, I think they're one of the most underutilized tools in investment planning. And, quite frankly, you talked earlier about the deficit, the taxes and interest rates. And, our country is going to have to raise taxes. And we're currently in one of the, cheapest times of tax rates that we've ever been in our nation's history. We call it taxes are on sale right now with that Trump Tax Cut Act. But that's going to sunset here very soon, I think in 2026. Or even prior to that, with the current administration, they're wanting to raise taxes badly. And they already have, I think, started implementing some things where they're going to try to change tax rates on different things. But, more than likely, in order to cover that deficit that we have, this insane amount of debt, we're going to have to raise taxes, right? And so who are they going to raise the taxes on? It's going to be the people that have money. Yep. The people that are still working or the people that have money in IRAs that's saved. And when that money comes out, it could be taxed as high as 40, 50, 60%. We don't know what the future holds, but more than likely taxes are going to start to increase. So let's take advantage of the low tax rates now. Let's do the Roth conversions now, or let's set a schedule. Maybe, the cool thing about the Roth IRA is that when you turn 72, you do not have to take required minimum distributions.
It's a big deal.
It's a big, big deal because if you're just in an IRA or 401k, once you turn 72, you're going to be forced to take money out that you may or may not want to take out. And guess what? What if you have to take it out this year in a down market? And so now you're taking money out, you're getting taxed, and you're selling at the worst time, right? So you have no control. So get control of your retirement funds. Let's put a plan in place now to get you into a Roth, whether it takes us 1 year, 5 years, 6 years. But I try to get people fully converted by the time they're 72. That way they don't have to take the required minimum distribution. So now they can let their money stay in there, grow as long as they want, tax-free. And by the way, when they pass it to their beneficiaries,
bring that up. Yep.
It's tax-free. So, if you keep it in the IRA and just kind of go about your business as usual, you're going to be paying high taxes on it, which is going to kill your overall cash flow long term. And whenever you pass it to your beneficiaries, they're going to have to pay tax at their current tax rate. So you're giving back 40% of what you worked so hard to earn. And so, we've got to utilize that tool and get people to start thinking about the Roth conversion. So if you have questions about it, just give us a call, reach out to Randy. Randy does an amazing job with his clients, walking them through those strategies and seeing if it makes sense at any given time. But reach out, explore it. No one's going to hold a gun to your head and say you have to do it, but you owe it to yourself to at least educate yourself on what would it look like to me and my family if I started doing a Roth conversion.
You bring up a good point about tax rates, and when we talked on our radio show at Take Point, it doesn't matter whether you're a Democrat or Republican. If you're a big Trump person, a bbig Biden person, both administrations we're borrowing money.
Yeah.
So it doesn't matter. It's all of our faults as Americans. We can all sit here and blame each other, whatever. But at the end of the day, we're all got to be responsible for paying the bill. Yeah. And to your point, Eric, the people that actually have the money, the ones that are going to have to pay. So the best thing to do is, while these tax rates are lower, lock in the taxation on those dollars at these lower rates, and then when you pull the money out in the future, there won't be any taxes to pay on it. Let's talk a little bit about retirement plans, since we're coming into the end of the year, and I know that there's so many variables here, so I want to get deep in the weeds, and for our listeners just want to, there are several types of retirement plans that are out there. One of the ones that we see, probably 30, 40 years ago, there were a lot more companies that had pension plans, and there would be a defined benefit or defined contribution plan. A lot more of those out there, SEPs. Or there's still quite a few of those out there, but what I've seen more and more in my practice is, some 401ks, but a lot of simple IRAs.
Right.
So let's talk a little bit about the simplest, and that's probably the one that most people wind up being involved in. You want to talk a little bit about that and how it's beneficial for a small business owner?
Yeah, it's a great tool. It's basically what they call the poor man's or the small businessman's 401k. It's an awesome tool because it's simple IRA. It's in the word simple, right? It is very simple. It's basically setting up your own IRA for each employee. They have total control over it. They can choose their investments. They can choose where they house the investments at. It's going to be a great retention tool for your employees if you can offer them that benefit. And it's also going to reduce your corporate taxes. And you're going to be helping people. You're going to do a good thing. You're helping people save for their retirement. You're offering them something. And so that should make you feel good as a business owner. But more importantly, to you as a business owner, right, you get to reduce your corporate tax plus your personal tax rates and contribute into these. And you can typically, it's about $14,000, I think, this year in 2022 to max it out. And then the corporation can match that up to, typically we see 3%. We can custom design them, but and the cool thing about it is there's no auditing, there's no reporting.
Yes, that's nice.
It's really nice. So if you do a 401k plan, it's much more complicated. You have to have a third-party administrator.
Plan document.
You have to have plan documents.
Returns.
You have to file with ERISA. People are open up themselves for audits all the time with those type of things. So literally, you don't report anything to the IRS. It's so simple. Yeah. And so it's just a great, great tool. I think that everybody's missing out on that, 100%. Doesn't matter if you're saving $50 a month or $500 a month. It's going to help out a great deal. And so I urge people to really take a stronger look at that.
That's what we have here at Suncoast CPA Group. It's a simple IRA.
Yeah.
So I highly recommend if you have a small business, even a medium-sized business, with under, I think you can do simples up to 100 employees. I'm not sure what the limit is, but I think it's 100 employees. Yep. So if you get under 100 employees, definitely a simple IRA is something that you should consider. And, sometimes people just need structure, and so probably a lot of your employees would like to start saving for retirement, don't know how to, don't know where to start. You providing this for them is going to be a big service to them and a big benefit for them just by giving them something that there's an opportunity here, So I think that here again for employee retention, they're really going to, my staff appreciates it here. Anything else you want to talk about? That was the things on my list. Anything else you want to talk about before we wrap up the show? Anything you want to close with? Or
I just want to close with, I think that today, obviously, with what we've been talking about and what people out there are feeling, it's an unprecedented time. More than ever, you really need to think about getting a second opinion, sitting down with somebody, and reevaluating what you're doing. Today's 60-40 moderate portfolio is nothing like our grandfathers, and going forward, you might be lucky with kind of what's going on if you're going to eke 3 to 5% out on that thing, and you got inflation at 8%, you got fees on top of it. So with the drag on bonds and the pressure on stocks, so we have a lot of alternative strategies here that I'd love to share with folks. And get you on the right path and just reevaluate things, because it's a challenging environment. And so no matter where you're at, it's not about what you make in the up years, it's about what you conserve in the down years.
Very
true. We structure our portfolios, for instance, like the markets are down 20%. If we're only down 5% in our portfolios, then we're like, hey, this is a big win for us, and we're super excited about that. Yeah, we're still down, but we're not down as much, and we're going to be able to fight and come out of that hole a lot quicker. So, I would just urge people, it's a very different environment, very different world, very different markets. And so get a second opinion. You owe it to yourself to take a little bit of time. You might have a great relationship with who you're working with currently, and I get that. And that person might be an awesome person, but they might just be stuck in a system that they can't offer you anything that's really outside the box. So, I just urge you to take control of your own money, get a second opinion, and reevaluate things more than ever. Obviously, when the markets are just going up, anybody can make money, right? But when we're in this kind of environment, it really makes sense to get some new strategies, get a second opinion, and kind of look at things a little bit differently. And, more than ever, just get a second opinion.
I agree. And here at with Eric and I at Take Point, we're independent advisors. We're not with a national brand. And yeah, we have compliance. We're part of an RIA, and everything we do runs through compliance. But we don't have all of the restrictions that some of these bigger companies have. So we can offer all kinds of different products to you. So. To Eric's point, yes, please come see us. Let's get a second opinion. You can call us here at Sunco CPA Group at 352-596-2883, or reach us on the web at suncocpagroup.com, or you can reach us at takepointwealthmanagement.com.
Yeah, takepointwealth.com.
Takepointwealth.com, yep. Reach out to us there as well. Schedule an appointment. What's our phone number over there at Take Point, Eric?
352-616-0511.
So reach out to us at Sunco CPA Group or Take Point. Love to talk to you and see if we can help you out. Thank you for listening. Have a great day.